Hello, everyone. Welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. I'm your host, Brian Rogers. Investors are often told about the importance of creating an investment plan they can stick to through the thick and thin of their investing journey. And a key piece of that plan is an investor's asset allocation, or in other words, the investments they hold within their portfolio. Case in point is a research study by Robert Ibbotson and Paul Kaplan. It found that asset allocation can explain a whopping 90% of a portfolio's volatility and 40% of the difference in returns between portfolios. Now, traditional asset allocation like the 60/40 portfolio have historically delivered attractive risk adjusted returns for many investors. But these days, finding the right asset mix might not be as straightforward. Inflation has been running hot, and interest rates have been at multi decade highs in 2023. So it may be tougher for investors to earn the returns they need to reach their financial goals. Simply put, higher inflation requires higher returns. Well, fear not. We're going to explore how investors can tweak their asset allocation to help bolster their risk adjusted returns. Joining us is Roxane Lapenna, Vice President and Client Portfolio Manager of Asset Allocation at TD Asset Management. Roxane, it's great to have you on the show. Thanks for joining us today.
Thanks for having me. Really happy to be here.
All right, well, I'm glad I got through your title. It's quite a long one for sure. It's a very big mouthful for sure.
A little bit, yeah, yeah. Thanks for doing it properly.
I wanted to ask you a little bit more about that. Can you tell us about the work that you do at TD and your experience with asset allocation strategy?
Yeah, definitely. So I work with the asset allocation team at TD Asset Management, and essentially the team manages $100 billion in assets, or said differently, $100 billion in client money, and that really touches every client type. So we see clients from TD Direct Investing, from branch banking, high net worth clients, whether it's internal or external to the bank, as well as institutional clients. So if you think about institutional clients, are things like pension funds, for example. And really what we do is we manage full portfolio solutions for a wide range of clients. And our goal is to help these clients meet their investment goals. So we're always thinking of the best asset mix, or the best way to get our clients to where they're trying to get to achieve their investment goals in the smoothest way possible.
All right. Well, that being said, too, why do you think asset allocation is such an important piece of an investment plan?
Yeah, I think, obviously making investment decisions it's incredibly challenging. It's certainly not an easy task, and every individual has investment goals that they're trying to achieve. And so you really need a little bit of guidance in terms of what's the best way to get there. And with the plethora of investment options, I think it's kind of overwhelming for people. So making sure you have, that optimal mix of, call it bonds, equities, whatever it may be, that can smoothly guide you towards your investment goals. I think that carries a lot of weight and a lot of value for individuals.
All right. Well, that helps kick things off. Let's get into our conversation. I have a lot of great questions for you today. First one being is let's lay a little groundwork for those in our audience who might be relatively new to the concept of asset allocation. So, what is asset allocation, and what does it aim to accomplish?
Yeah. So, maybe kind of a bit of an analogy might be a little bit useful. If you think about assets, like, for example, ingredients in a recipe, as opposed to just thinking about it from an investment perspective, if your goal right now is to bake something that's sweet versus something that's savory, it's pretty logical that you're going to need different ingredients to deliver that desired outcome. So ingredients in investing, it's kind of the same thing, right? But what we're thinking about here is obviously a little bit more complex. And we're talking about things like, do I invest in equities? Do I invest in bonds? Or maybe do I add some alternative exposure to a portfolio? But really the weight of these assets in your portfolio will vary quite a bit depending on what your investment goal is, or the goal of the portfolio. But the main concept, I'd say, for asset allocation really is diversification at the end of the day. So I think we probably all know not every asset will go up in value at the same time or go down in value at the same time. This will not occur in a synchronized fashion, but that's what you want. You never really want all of your assets to be going up or down at the same time, or said differently, you never want to be holding all of your eggs in one basket. So the secret sauce here is having that well-diversified portfolio where you have these different types of exposures that don't react necessarily in the same way to the same market events. So, if one asset gains value and the other one kind of moves in the opposite direction, that's usually an attractive correlation profile or an attractive diversification profile for investment portfolios.
Absolutely. No, that's a great analogy. I like that. I'll have to steal that one. So, why would an investor need to set an asset allocation strategy rather than simply choose the specific investments they feel will perform the best over time?
Yeah, well, I think, this would certainly be a great idea if, you had a functioning crystal ball and you knew exactly where everything was going. But as far as I know, that doesn't exist. Of course, if anyone has one, please reach out. I would love to have that. But the reality is that the world is uncertain. We don't actually have the ability to predict where anything is going. And since nobody is ever able to consistently pick winners or consistently predict timing of meaningful market swings, that just means that there are risks that will come up if you're focusing on investing in one security or one part of the market. And there's a lot of different risks that you can kind of think of. I think the top one might be over concentrating in your portfolio. So if you have too much concentration in one sector, one asset, generally this leads to increased volatility in your portfolio. And we are human. So when we look at our investment portfolios, we work hard to save this money. So seeing the fluctuation or seeing a big kind of loss or drawdown in your portfolio, it's going to evoke an emotional reaction. And the last thing we want in terms of, having a goal of reaching certain investment goals or outcomes over time, you certainly don't want to panic and sell when things are low.
All right. So now there are many some possible combinations of investments that investors could choose, which make the process seem a little daunting. So, what are some of the key factors an investor may want to consider as the framework for their asset allocation?
So the first and foremost, you really want to focus on what your investment horizon is or what time frame you have. So in other words, when are you going to need the money? So if you're investing because you want to buy a house in a few years, that's a bit of a different situation than if you're investing for a kid's education in 10, 15 years, or, maybe a trip next year or retirement in, I don't know, 30, 40 years, depending on how old you are. They're all going to require different things. And I think, the easiest one that everyone can probably relate to is retirement. Everyone is trying to retire at some point in their lives. And age would be a big factor there when you think about the time horizon and the time frame. If you start investing when you're 20, well, theoretically, you could probably, potentially stomach a full 100% stock exposure portfolio because you do have that time horizon to kind of get there and reach your goals, and you can stomach that volatility. The second key theme after other than time horizon would be your risk appetite as an individual. So, maybe you do have a lot of time. You are saving for retirement. Again, you're in your 20s, but maybe your risk appetite is really, really low. You literally cannot stand volatility. So in that context, you're going to have to think it through as well. And maybe a full stock portfolio is a little bit hard for me to stomach because I'm seeing too much volatility. I'm feeling too much of the risk in the markets. But then you also have to take into consideration, what does that mean for meeting your investment goal? Because again, putting all of that money when you're 20, 25 in bonds, that might not create a scenario where you can meet the investment outcomes that you're trying to achieve. And so, in that sense, you might need to save even more of your personal income to kind of make up for that difference if you really aren't willing to take additional risk.
All right. So we have our framework in place. Now let's talk building blocks. Stocks are one of the asset classes that typically serve as the foundation of a diversified asset allocation strategy. Why is that?
Investing in stocks, it's a way to participate in the growth of an economy, in the growth of corporations, the growth of an economy in general. So that's how you get that growth profile, which obviously other asset classes will be very different. But specific for stocks, if you think about it, if you're investing in shares of a solid company, they're very high quality. They've got, really clear lines to their cash flows. They're selling goods or providing services that are deemed essential. And, people are willing to pay for these goods, pay for these services over the long term. Well, theoretically, that company, as long as it's well managed, should increase in value. If we kind of look back and you think about historically, they really have provided those higher rates of returns for investors in portfolios. And it really helps fight other, call it invisible taxes as well. So if you want to invest to beat inflation, which is obviously needed to kind of maintain that purchasing power, that's where investing in the growth of companies and the growth of economies really does come into play. But again, stocks, they obviously tend to have higher volatility when it comes to from a performance perspective, especially over the short term. But if you look at it over the long term, The bull markets or the positive markets are always, more meaningful, and they last longer than the bear markets or the drawdowns. So over the long term, if you can kind of, strap in and hold it, you will be making much more accretive returns in the stock market.
All right. Well, yeah, hearing all that, you think of they seem to be a little bit more exciting in the news. And like you said, you're participating in growth of the economy. So hearing all those things, some investors might conclude that, 100% stock portfolio would therefore be optimal. Like, what is your take on that?
Yeah, I mean, it does sound like we're painting a very rosy picture, obviously. Just buy stocks, and over the long term, you'll do well. So at the surface, yes, it makes a lot of sense. But I think the reality, again, is it can lead to that panic selling in times of stress, or it leads to kind of facing scenarios where your portfolio is down meaningfully right when you need the money. And I think that's the part that's key. I think we refer to this as sequence of return risk kind of internally. So, and really what this means is it's the order in which investors experience their returns. And this can really have a huge effect on the longevity of a portfolio. So for example, if an individual starts needing to kind of withdraw their money at a certain point in time, and this has happened right after a meaningful stock drawdown, that can be detrimental, not just to the current need for that money in that given year. If the scenario is retirement, okay, maybe you need a chunk of those assets right now, but starting to withdraw when markets are down, it means that you're eating away at an even more meaningful share of your investment base. And so then going forward, you have an even smaller investment base to continue to grow until the next time you need to withdraw money. So the point here is stability really is key as well. The timing when you need to withdraw is key. And if you're forced to take out money when the stock market's down and you didn't have anything providing stability in your portfolio to kind of balance that out, that could actually be quite detrimental. So sometimes from a human psychology perspective as well, it can help to just think about the different chunks of your portfolio in terms of different time horizons and different investment goals to kind of calm you a little bit when there are times of stress, and you can remind yourself, okay, I don't need this money until 30 years, but the money that I do need in 2 years, it's okay because it's in some short-term fixed income, for example.
Okay. You can set that aside for sure. I know you have probably heard these as well. I've been in the industry for quite a long time. You hear those horror stories of, let's say in 2008, where people were retiring and they were all in equities or stocks and they'd lost, half or even more of their portfolio. So that timing is really important. I know we've talked about the idea of balance a lot so far in our conversation. So how might an investor strike the right balance of stock exposure in their asset allocation strategy?
Diversification isn't just a question of, oh, bonds and equities as kind of standalone buckets. Like you have to also think about diversification within each of those asset classes. So diversification within equities. So if you think about diversification of stocks within the portfolio, there's a lot of different ways to think about your options for investing in stocks or different sectors. So there are obviously stocks that can be more volatile. Think about things like tech, mining, oil and gas. So you will feel more volatility. You'll experience more risk in those types of sectors. And then there's other sectors that can be a little bit more stable. So more, consistent cash flows, even when markets are a little bit more challenged. So, everybody needs to eat. Everybody needs to pay their utility bills. So if you think about consumer staples, utilities, these are things that are still going to be quite stable during, times of stress, or more stable than other sectors, for example. Having that diversified mix, it can really help an investor kind of maintain that higher exposure to equities when that's something that they need in the portfolio. And you're doing so in a way where you're not assuming excessive risk, because at least you're well diversified in your equity exposure as well.
Okay, the other foundational asset class is bonds. Why are they an important piece of an asset allocation strategy?
First of all, bonds, they're essentially contracts at the end of the day. So they act very, very differently than stocks. And when I say they're a contract, that really means that, if the underlying company or the underlying government doesn't default, you will get your interest paid regularly and you will get your principal back at maturity. That is a contract. Now, so what that does is it gives you a level of certainty and a level of stability that stocks just can't provide. Holistically, that's why it's the cushion in your portfolio. That's why it acts as safety. Because generally speaking, if we go back in history, in environments where you do see meaningful equity market drawdowns, you will, for the most part, especially government bonds, you will see them increase in value. So again, that negative correlation that we're talking about, equity markets are going down, bonds are going up. And that's why we like bonds in a portfolio. It's that correlation benefit, it's a diversification. We also, from an asset allocation perspective, look at it as capital preservation. So, it on the one hand, it's, that cushion from an asset allocation perspective, but, let's say you're a wealthy individual that, has a lot of money and their only fear is to not lose that money. Well, you'll buy bonds because that will preserve your capital.
One of the things I wanted to delve a little bit more into is that bonds, they tend to deliver lower returns. So you did mention that you're going to get a lower return than stocks. What could an investor consider doing to help them boost the return potential of a bond portion of their portfolio? Is that possible?
100%. So just like I was mentioning when it comes to stocks, there are a lot of different types of stocks. You want a diversified stock portfolio. It's the same thing when you think about bonds. It's not just one bond that you buy. It's a diversified portfolio of bonds. And so if you're thinking about trying to generate additional or more accretive returns from your bonds, one thing you always need to keep in mind though is, where you are in the cycle. So right now, we're at the point where, kind of entering a challenging economic backdrop. Is it going to be a full-blown recession? Is it not? Verdict is still out there. But holistically, what we do know is it's a challenging market backdrop. We know that for certainty right now. And in these types of environments, you want more safety in your portfolio. So this is not the time to take additional risk and try to, get additional income from your bonds. You want to play it safe. So you want more government bonds in that situation. Now, if you're kind of out of this challenging economic backdrop, you're in a more, stable economic backdrop, then, you can afford to take a little bit more risk generally in your bond portfolio. And what that means is the risk that you would really be willing to take is more in the corporate bond side of things. And so even in corporate bonds, you have investment grade, which is very high quality corporate debt. And then you have high yield corporate debt as well, which is farther out the risk spectrum. So maybe think about high yield debt as, maybe a small cap tech stock. If you're trying to compare it to the stock market, you can potentially get more money, but there's also that risk that the company doesn't do well. You'll have more risk of bond default in the high yield space. So yes, there's always a way to generate additional income or generate more money from your bond portfolio, but you really, really need to do it in a way that, is well balanced, well diversified, and taking the risk of the market into consideration as well.
All right. Yeah, those are some really interesting strategies to consider. All right. Well, thanks for walking us through some of the basics of asset allocation, Roxanne. So, with all that said, why do you think that investors may need to rethink traditional approaches to asset allocation, like the 60/40 portfolio?
If you think about the decade that we were in the 2010s, it was very low volatility when it came to inflation, low volatility when it came to growth. It was kind of smooth sailing, really. But now a lot has changed in the past few years. And we really do think that we're probably going to be in an environment with higher volatility of growth, higher volatility of inflation for, potentially an extended period of time. And so basically, because of that, you want to think about different exposures like alternatives, for example. And the goal being not only just, improving the returns, but reducing risk.
Well, you mentioned the alternatives. So, what are some examples of alternative investments that can help bring additional diversification, for example, to an asset allocation strategy?
Definitely. I'd say there's, a wide range of alternatives. I think they've only become more and more popular over time. I think, whether it's private market investments or liquid alts that are kind of available, there's a lot of different ways to kind of access this. And so when we talk about what makes it different, or when we're talking about alternatives in general and why we like them, oftentimes it's because they deliver a different stream of, like, whether it's stream of income, or they react differently to market moves. So just the drivers of returns for these things are different.
Of course, each investor's financial needs and goals are going to be unique, but in general, how much of a portfolio might it make sense to allocate to these alternative investments?
It's not meant to be a core exposure in your portfolio. Equities, bonds, they are the core. They should remain the core. This is an added diversification lever. So, because of that, you really want it to be more of a smaller portion in your portfolio. Otherwise, it may actually not have as much of a diversification benefit if it's kind of overwhelming other exposures in your portfolio. So from that perspective, we would basically say you wouldn't really want more than maybe a 10% allocation in your portfolio, something like that.
We don't have time today to go into all the different alternatives for sure. But I know if we wanted to focus on one that's accessible to the audience here, I would say we could start with commodities. I know you said that one's fairly important. What might that bring to an asset allocation strategy?
So yeah, definitely commodities have become a very topical thing. They become more and more common. I think, it used to just be something that pension funds were investing in, but now it's actually accessible to retail, which is great. And one of the key reasons why it's even more interesting for retail portfolios at this point in time is that inflation protection component. So inflation protection is incredibly key when it comes to commodities. It's actually, it's one of the few asset classes that has been able to outperform in periods of rising inflation. And that's again comes back to the essential nature of commodities. You need energy for a well-functioning economy. You need the inputs to food. So it's in a lot of ways it's very highly correlated or tied to movement and inflation. So having that exposure in your portfolio is great. Diversification. It actually has incredibly low correlation again to a lot of other asset classes. So think basic equities, stocks. So you get that diversification benefit, but you also get sort of what we call the thematic tailwind. We do think that we're entering more of a kind of a bullish cycle when it comes to commodities, because holistically there's been an underinvestment when it comes to oil. There's been an underinvestment when it comes to metals. And because there's an underinvestment, that's just, we go back to basic supply and demand fundamentals. We don't think demand is going to be deteriorating, but we have seen a deterioration in supply. So it's kind of a win-win-win.
What are some of the types of publicly traded investment products out there that can help investors gain exposure to commodities?
Yeah, so I think that's a great question, because there's actually a very different way that you should think about the different ways to invest in commodities. So a lot of times people just think like, oh, well, I could buy oil stocks, or I could buy an ETF that's a basket of oil stocks, or whether it's metals or whatever the underlying commodity you're trying to gain exposure to. And that's great. You will see some diversification benefits in your portfolio, so that's one way to get some of it. But at the end of the day, you're not getting the full diversification benefit when it's still on the equity side specifically, because really you're mostly getting exposure to the company operating, the operating company at the end of the day, and not direct exposure to the underlying commodity. When you do see, market downturns, oftentimes correlations again amongst stocks tend to feel like they're going to one. The market kind of just all goes down together. So in times of stress where you need diversification benefits the most, that's actually when those oil stocks will not provide as much of a diversification benefit. So it does provide some diversification benefit, but there's another way where you can get more diversification benefit is my point here. So there are some liquid alts out there where you're investing directly in the derivatives. So in the futures contracts of the underlying derivatives of the underlying commodities via derivatives. The derivatives market does give you exposure to the underlying commodity directly. And that's where you get all of those beautiful direct inflation benefits, direct diversification benefits, and direct exposure to the actual underlying price of that commodity.
Well, just a quick reminder to our audience as well. If you'd like to learn more about the role commodities play in diversifying a portfolio, check out our webinar, How Commodity Exposure May Help Protect a Portfolio from High Inflation. It's available in the Learning Center on Webbroker and on TD's YouTube page. All right, so now let's move on to our next alternative asset class, real estate. What might it bring to an investor's portfolio?
What you're really getting is the low correlation. And I will preface it by saying most of the lower correlation benefits that you do get do come from the private markets, but you still get some of those low correlation benefits for both real estate and infrastructure in the public space as well. And again, that really comes down to what those fundamental drivers of returns are at the end of the day. So, they all have this very, very predictable income stream. So if we only think about commercial real estate, you really want to remember those rental agreements that are in place, because they do tend to be long-term commitments. And so what that means is that they provide that steady, predictable, and even actually most of the time inflation adjusted cash flows it's embedded in the contract. The same thing would be for infrastructure. So because these inflation adjustments or adjusters are in the contract, you always get that inflation protection. So it's not just about the stability of those cash flows, it's the fact that they are predictable and you do know that they will increase over time. So again, thinking about the inflation hedging conversation, I talked about it when it comes to commodities, but it's the same here, because how many things can you buy where you automatically know it's going to increase with inflation from an investment perspective? That's never really a guarantee. But when you do have something that's contractual, it's embedded in the contract. You're getting that inflation adjustment. And at the end of the day, that because you have these different return drivers or different return streams for these types of assets, that gives you that low correlation to our traditional assets.
All right. So, what are some of the types of publicly traded investment products, I should say, out there that you could gain some exposure to real estate?
Yeah, so most of these would be on the ETF side. I'd say, the best way to really think it through is to have that well diversified basket of securities to make sure that you are well diversified, maybe even diversified globally, diversified amongst geographies, diversified amongst our real estate sectors. I did obviously talk about office, but there's a lot of different sectors that are very relevant. So, multi-unit residential, for example, apartment buildings. When you look at a lot of areas of the world, there's an undersupply of apartment buildings, so those are very kind of accretive for portfolios. Industrial space, that's something that became incredibly popular throughout COVID as well. There's cold storage everywhere for grocery delivery, but even just Amazon fulfillment centers, that's commercial real estate. So these are also, when we talk about wanting high quality underlying assets, we're also talking about the quality of the tenants. You don't want to go too far out the risk spectrum. Even thinking offices, if the underlying office buildings are, class B, that's how, or a lower class, not as high quality office building in the middle of nowhere, well, maybe you might worry that the tenant that's occupying that space might not pay their rent. But if your office buildings are downtown Toronto and it's a major bank renting out the space, they're going to pay their bills.
Okay, now that we better understand the role of alternative investments within a portfolio, let's put it all together. How might an investor want to consider adjusting their asset allocation in response to different economic conditions?
We probably are going to be navigating through different states of the world, meaning different types of economic regimes or, economic cycles more quickly than we would have been used to in the last decade because of that additional volatility. And not all assets are going to work well in every type of environment. So that's why you want additional options. So, for example, if you're in an environment with high inflation, like I mentioned, you do know that commodities are going to be a good option for, again, real estate or anything that's really inflation linked. If you're in an environment where, you got low inflation, but you've got high growth, equities are always going to be your friend. So it's really just thinking through what types of exposures you might need in your portfolio. Another one, people kind of ask a lot of questions about gold. Generally speaking, low inflation, low growth environment, gold does well. But I will say it's really, really hard for any individual person to time this properly. All of this requires a level of tactical management to really be able to adjust these types of exposures within your portfolios. And so I'd say the last thing you want to do is try to get, too excited and pivot things around too much. You want to think through having these types of exposures depending on the economic backdrop, but, don't switch it, don't go 60% equities one day and then 20% equities the next day. That's not what we're trying to accomplish here. I think it's just being more tactical with those smaller allocations. So like the commodities, like the real estate, like the gold, things like that, and make sure that the bulk of your portfolio really is stable. Yes, tactical asset allocation matters, but your investment goals and your time horizon matters the most.
So, all right, Roxanne, thanks for giving us a tour of some of the alternative investments or assets for investors to consider as they diversify their asset allocation strategy. And on that note, let's take a moment to hop into Webbroker to show our viewers how they can start their research into alternative investments. So I wanted to take you through a quick review of how you can find some of the alternative investments that Roxanne has talked about today in Webbroker. So the first place you're going to want to start is under the research tab and then sectors and industries, and it'll take you to a screen that looks like this. Unfortunately, it's not going to just be highlighted with saying these are alternate investments. So it may take a little bit of digging, and you're going to have to do it in a bit of a roundabout way. So if you're on the sectors and industries, that's one way to start. Is you can see there's top sectors over here like technology, healthcare, energy. So if you are looking for commodities, you can find some of the energy categories you might be looking for. There's basic materials and other ones you can see listed. There could be real estate. Not on this one right now. There are utilities. If you are just doing a quick start, if you click on each one of these actual categories, if you go to basic materials, now you're looking at the ability to get into some of the other commodities that are available, and you can continue to click each one of these items. If you're looking at, if you do some research and you realize that aluminum might be a commodity that you wanted to enter into, now you have some positions. These are equity positions you can review to add that to your portfolio. Now, if you want to go to be more specific, you can actually go to the research tab and you can go to the screeners tab and you can screen for not only equities, but also mutual funds and exchange traded funds. So as this loads up, you can see here we're on the stock screener tool, and you can see there's some pre-screens that are set up. There may be some that are similar to what you're looking for potentially, like ESG stocks and some other things. It could be fixed income as well. But what you're going to want to do is you're going to actually go into the screening tab. So click on screening, and you're going to start adding criteria. So you can see here, I have, if I want to add more criteria, there's some ones here that you have that are going to come up automatically. I like to use the bulk edit. So over on the right hand side, if I click on bulk edit, now I can add a number of different things right from here. So if I go to more criteria, there's price performance 52 weeks. So there's a few automatically that will come up. You can do stock price. So you can set some of those, but then if you add on more criteria, now you can look at sector and industry. So if you want to go to sector and industry, there's going to be a much larger list. So if we scroll down and we pull up here to the sector and industries that I just added at the top, I can see there we go. There's basic materials if I want to look at, steel, chemicals, etc. Or if I want to look at real estate, we mentioned maybe real estate investment trusts. There's REITs. I can just deselect all these, add REITs in there, and then I'm going to get a list that's going to be much smaller in these areas. So, we have utilities, we have technology, communication services, and so on. So that being said, that's a way you can do that with stocks, but you may be able to find ETFs that are a little bit more specific to add a particular element to your portfolio. So if we click on ETFs, exchange traded funds, and then you're going to go to create a custom screen. I'm not going to show you a full screen itself because this is just one category of it. If we click on fund category, you can then select other criteria you might want to add. But just to get into the point where you're looking for maybe real estate stocks or ETFs, or if you're looking for or something of that nature, now you can see that this list is much bigger. And I can see there's aggressive allocation, some of these other ones that are more ETF based, they're a little bit more diversified. But now you can go down, if you scroll down for commodities as an example, we can continue to scroll. There's a huge list. And there we go. So there's commodities in Canada, there's commodities focus, there's a commodities broad basket. And if I keep going down, if I go into real estate, go down to the letter R, there we go. There's real estate equity. So there's a number of different categories and sectors that are available there. So search through, that's just one way to get started. There's other ways you can do a Google search and just find a symbol that you're looking for or find a fund, an ETF fund, pull up the quote and then just research that further. There's going to be an overview in WebBroker, but that's just a way to get you started on finding some of these alternative investments. All right, we're going to have to leave it there, Roxanne. Any final thoughts you'd like to share with our audience?
Well, first of all, thanks for having me. And I really think there is a couple of things that are key. The one thing that we say internally all the time is time in the market is always more important than timing the market. So really having a well-diversified portfolio that does align with your risk profile, that aligns with your investment goals, it is the optimal solution to being able to stay invested through all of these different challenging times. And ultimately, it's the optimal way to reach your investment
All
goals.
right. Well, thanks so much again for joining us. And for those in our audience, make sure to register for our upcoming live webinars and check out our library of on demand content available in the Learning Center and on our YouTube page. See you all next time.